Hello, hello. Still not used to this whole post-COVID situation where I don't get any reaction when I say hello. Hi, my name is Todd Sivia, and today we're going to be talking about keys to success for successful succession planning. I'm the owner and purveyor of Sivia Law, and so let's get started. During the course of this webinar, we're going to be talking about succession planning, but at any point in time you have any questions, feel free to post your questions in the chat box or send me a message through chat, and I'll do the best I can to respond to those questions as they come in. But I will definitely be leaving some opportunity open for us to answer questions at the end. So let's get started. Why do we need a plan? There's two quotes that I like. One is Winston Churchill, is he who fails to plan is planning to fail. So we need to have a plan in place at all points in time. And Michael Gerber, who is the great purveyor of E-Myth, the book E-Myth, he talks about succession planning, and he has a newer book called Beyond the E-Myth that I'm totally in favor of. And one of his beginning quotes is, when you start your business, you need to have a succession plan. So everyone that starts a business needs to have a succession plan, whether you like it or not, because from the day that you start, you got to know what our next steps are. So it is extremely important to plan for succession. So succession and what's called exit planning for privately held businesses. I actually have a couple extra designations and certificates, and it's called Certified Exit Planning Advisor, or CEPA. Also, there's the CEXP, which is Certified Exit Planner. And we're always talking about exiting the business. And exiting the business does not mean that we are walking away and walking to retire. We may be walking away to do other things. We may be walking away, passing off leadership responsibilities. So those are things that are going to come up. An exit plan, and if you've done it correctly, a well-designed plan, and allows you, the client, to control the process and timing of your business exit. Achieve personal and financial goals, maximize company's value, facilitate your retirement, explore all valuable options for your business, promote long-term growth. Because just because you're transferring the main thing with a business is you can transfer it. And the business can keep on going without you. Sometimes that's positive and negative, and everybody doesn't like to give off that control. But transitioning your business and that control is very important. And minimizes taxes. The biggest cost in exiting is taxes. If you exit your business correctly, we've worked on ways to minimize that taxes and the tax implications of that. So, failure to have an exit plan is not achieving is just the opposite of just what we talked about. It is not achieving your highest value of your business, not being in control of the timing, creating. You may create a family fairness issue of somebody having control or not having control, or somebody receiving more benefits than the other because they're either working for the business or not working in the business. And there's a whole other issues with that. Not providing for an atmosphere of longevity of key employees, and making sure your key employees have an incentive to keep coming to work, and not leave for other greener pastures. Certain people get to a certain point and they want to continue to grow and continue to expand. And if you give them those key employees an incentive to stay, that's part of the successful succession plan. And creating uncertainty for certain stakeholders. As you get older, there are certain things, for example, older doctors. Nobody wants to go to an older doctor because we don't know when they will return. Succession and exit planning is very personal, and so it is not a one-size-fits-all. You can't just wave a magic wand and say, this is your exit plan, or you can't cookie cut a plan and say, here it is. This plan, anytime we're talking about a succession plan or an exit plan, any kind of business is very personal. We've got to know your goals. We got to know your wishes, your dreams, and what do you want to see out of this. A successful exit and a successful succession plan should be one that can easily be updated as current state affairs change. When there's pandemics, when there's hurricanes, when there's this, that, the other natural disasters, that all has an impact. But also, if there's an issue with regards to anything that should pop up. Succession plan is an orderly process by which ownership and management of a business are transferred either to the next generation or to the next individual. So that is truly what a successful plan is. So let's meet Edna. Edna's husband, Wilbur, died in 2011. The company grossed over $2 million in revenue, and it was doing pretty well, profited about $200,000 per year, including a salary. Employees, there was about 10 of them. There's probably $50,000 worth of inventory, and there was real estate worth about $130,000 in this business that Wilbur was running, but there was no succession plan. So Edna, a month after Wilbur's death, she shut the company down. She sold the inventory for about $40,000, sold the real estate for about $80,000, and paid taxes on the sale of about $73,000. She walked away with $46,000. If you ran the numbers, the company was worth approximately $980,000. So because of failure to plan, there was a substantial loss in value. Shutting down the business is not always the best thing. And there was some value that was left on the table. But, just like all spouses, and doesn't matter who it is, but spouses will on occasion, not be working in the business and really not know what's going on in the business. And so having a spouse take over a business who hasn't been involved in the business or really doesn't know much about what the business's worth is and who's doing what and how things are running, The spouse that's not running things feels overwhelmed, feels like they don't know what to do. So they look at all the best options and do the best that they can. So please don't be Edna, and let's look at some ways to avoid Edna's situation. So here's the 5 reasons for planning for succession: taxes, risk, having options, control of the transition, and obtaining value and transferring that value. So taxes is probably the biggest issue with regards to a transition. So I'm going to use a situation of an asset sale, and this is a difference between an S corporation and a C corporation. Hopefully, we don't have that many C corporations that are on this seminar. C corporations are definitely not as favored as they used to be, and I don't know of very few. I know of very few C corporations, and so we want to make sure that you've got your taxing issues situated. So here's the sale price of a C corporation versus an S corporation. So C corporation, we have a scenario of $250 million in cash, with $250,000 of cash sitting in the bank account, and there's accumulated depreciation. So at any point in time, there's always accumulated depreciation. So we always have to be mindful of that. So if we sell it for $1 million, and it's an asset sale, so we're selling the assets of the company. You pay $200,000 in taxes, or your taxable gain is $200,000. You're left with $80,000. You distribute that amount. Your capital gains on that leaves you with $840,000, versus an S corporation. We're talking about instead of paying a capital gains tax, you pay $100,000, or you don't pay any capital gains taxes. We switch that to a $2 million sale, and the reason why $1 million works is because you've got assets sitting there. So there's not much in what's called recaptured depreciation. So we're not as worried about that with $1 million sale, because your total assets are worth $1 million. Now, if we look at a $2 million sale, we do have to worry about it. We have, again, C corporations, you have liquid proceeds, tax, and then you also have taxable gains on the distribution. Then you also have capital gains. So on that $2 million, just slightly over 20% of it goes out in taxes. Here, you're saving some money. So running the analysis of what does that look like, we definitely pull in your accountant to make sure that we've looked through everything and made sure that everything we're running the numbers. So risk, but what is risk? the risk is, are you reaching your professional and personal goals? But the risk may be, any kind of number of risk. Risk may be the health of the owner. 1 in 4 individuals will have a disabling event in their lifetime. So at any point in time, 25% of us will have some issue. And if you're running a business and have a health issue, there's going to be a problem. There's also the risk of death. Nobody wants to talk about it, but there's always this risk of death with anything. So we definitely want to make sure that the business is not risk adverse with regards to that. So options. When we talk about options, what are we looking for on your long-term business goals? Do you have a dollar amount that you want to hit? Do you want an income base is that an option? Do you want available employment for family members? Do you want a personal legacy? All those things come into play that need to be asked. What is my long-term goals for this business? And so you have available options to reach those goals steadily diminish with time. If you don't have those goals set out, those may change, and you may not get what you're seeking. You're not getting your family involved. If you have a family member that is thinking about getting involved, but they don't see you retiring, that may be a disincentive for joining your business. Maybe they're just not interested in your business. Communicating those long-term goals is part of the process. Control. If you retain control over the succession of your business, the longer you're in control, the more you're in control, the more risk you have with somebody else dictating what control, or not having a plan. You have a risk of control issues, and that control issue may be enforced by the government or opposing attorneys, because you really don't want somebody to be disabled, and then you have to get a conservatorship to run the business, and then you have a judge determining who's in control and what they can do and what they can't do. Having a written plan is important. So 4 steps to successful succession. 1, understanding your goals. And what we're going to talk about is the human issues. Knowing those human issues is critical. So knowing the goals, developing a strategy, valuing the business, and then seeking to finance the arrangement. So let's talk about step 1. Step 1 to succession planning is understanding your goals. And you kind of have 2 diverging goals. One is the goals of the business owner, which is you, the shareholder, the CEO, the aging person, and you as an employee. You still are running the business, but you're still an employee. So you need to evaluate all those goals, but also the goals of your employees. What are those goals? What are they looking for? Long-term growth? Are they looking to work for you for a long period of time? So those are important. Review each goals. Review your income. Review how much involvement you want to have review your investment, how much and not just your investment in the business, but also your investments in general. How much could you get away with selling this business for? What is your legacy? And what are your true personal values? If your personal values is to maintain a family atmosphere, you probably don't want to sell to a big corporation. That's not fulfilling your goals. So stakeholders in a succession plan is a combination, and it's right within that middle of that sweet spot of between family, owners, managers, and employees. So it's right in between all those issues, and trying to balance each one of those issues is a truly successful succession plan. All right, there's also additional stakeholders. There may be other owners. So if you're the sole owner, what does that look like? Then you don't have that addition. But if you have additional owners, key managers, key employees, those are all additional considerations that you need to think through. It's also the human issue. Who are your key players within your organization, and how do we incentivize them? Are those key employees your people that could take over? Has the ownership been promised to anyone? Have you promised it to a child? Have you promised it to a key manager? How does that look like? And what does that look like? Which family members are currently active in the business? When you transfer that succession, and if you don't transfer it to that key employee or to a child or family member, what does that look like? What does that look like for them? Is that part of your consideration? So what is their commitment? What is your commitment to your business? How long do you foresee working in the business? Are you able to step away and work on the business? Those are key critical situations. Has a promise been made about who will succeed? It goes back to promising family members, promising, what promises have you made out there? There's always disruptions. If 2020 has not proven that there is a disruptive force, no year can ever prove that, because this is definitely the year. I'm waiting for them to announce some issue. We've had the murder hornets, we've had COVID, we've had riots, protesting. There's all kinds of life changes and disruptions that definitely have an impact. There's some other key critical ones. Death of the owner, disability of the owner, bankruptcy or divorce of the owner or a family member that was planning on taking ownership, retirement. If you want to get away from the business, that's going to be a disruption. A withdrawal prior to retirement, so you want to go do something else, that's going to be a disruption. It's doable, but it's going to be a disruption, so you need a plan for it. Other important issues. Is there any kind of long-term business plan? A lot of people always talk about, I need, when I first, a lot of people get started and they create, all these beautiful 50-page document on what's their plan, and and running numbers and everything else like that. And as soon as you start working in your business, that plan goes out the door. Nowadays, you need to have a true business plan that sets out, when are you retiring? When are you getting out of the business? What is a key indicator of that business? And things of that sort. What is a business's weaknesses? Is there some weakness in your business that somebody else can take advantage of? How will the business creditors react to an owner if they die or becomes disabled? A lot of people, have set up handshake deals where, I promise I'm going to continue to use you, but the second the main owner dies or becomes disabled, how true is that relationship? And would the owner ever consider selling it to their employees, which is a viable option? Are there any key employees who could afford to buy the business? That's a key component, is are they able to afford it? And how important is a guarantee that the business be controlled by the parties that the owner chooses? What if they buy it, turn around and sell it? Is that a critical question? Best case scenario, and that's the ideal situation. Is if we're trying to set up your best case scenario, that we get you your expected annual income for the business owner after the sale, net after taxes. Who will own how much equity in the business? That may be a key component in your best case scenario. An explanation of who will hold what portions and responsibilities, or hold which positions and responsibilities. One of the things that I always do is I do personality profiling on people with regards to potential family members, and try to determine whether or not that family member is the right fit. Years ago, I think it was like 3 or 4 years ago, we were looking at working on a succession plan, and there was this gentleman. He had 2 sons. We had one set. He had one person that he thought, oh, this is the person that I really, he's a go-getter. He's great at sales, and he's the person I want to take over. We did personality profiling and found out some key factors, and determined he wasn't the right person. He's a great salesman. He was not the best at running the daily operations. So, making sure that we know the positions and responsibilities of people and evaluating that is going to be critical. Summary of desired level of involvement. What's your involvement? Are you planning on staying involved in the business until you pass away, or are you willing to give up some of that control? And in summary, how often are those goals? How often are your goals being met? Are you on pace to grow? So that's going to be critical. So if we look at, kind of diagram this out, we look at everybody's goals, the owner's goals, and then the management needs, that sets up the best case scenario. Once we know what that best case scenario is, then we can start exploring options. And then third, implement. Step 2. So when we get into step 2, to succession planning, we start looking at strategies. So we've already looked through all your goals and all everything that, what the plan is, what strategically, who's going to be in what position, and everything in step one. So now we're at a point where we're ready to start managing this succession plan. So we start looking at who's capable of taking over, who's willing to take on new responsibilities. Are we starting to, and I use this phrase a lot, delegate and elevate. Are you delegating responsibilities to somebody else? And what does that look like? Does the person need any type of training to take over? I had a succession plan, again, a couple years ago, and in that plan, we knew that the person was a good fit. They needed a lot of training, and we knew that it's going to take another 4 or 5. We knew it was going to take 4 or 5 years of training and working in the business, in different areas of the business, in order to be able to take over. What kind of compensation structure should be instituted? What does that look like? Are we looking at a profit sharing plan? Are we looking at, what are we looking at? So we need to look at strategic options. What options are legally and financially feasible for compensation structures and things of that sort. Question is, and this is the perfect time at this juncture to ask, if I were to sell something, what am I selling? Are you selling real estate? Is it, do you have a certain amount of control over it? You don't have to actually physically own, but if you control a strategic lease, that may be just as good as owning real estate. If we look at, for example, McDonald's, kind of going off script, using McDonald's as a perfect example. McDonald's is one of those scenarios where location. So if you're on the corner of Fifth Avenue and you've got a McDonald's, and that may be valuable. Equipment. Are you selling equipment? Is it personal property? Do you own a car within the business that you want to keep? What's the equipment that you're selling? Goodwill. Goodwill is probably the biggest factor within any purchase, but it's hard to value. But people will pay a value if everything is processed and systematized and documented. So processed, systemed, and documented. So that's going to be a key component within goodwill. Having those systems and processes in place. Trademarks. Trademarks is a huge value. If somebody goes out and trademarks a name anywhere in the world, especially in the United States, if you own the trademark McDonald's, before McDonald's started shaping up, you may have control over those rights. The naming rights is just as important as anything else. So naming of products, naming of services. Once, having those trade names are important. Cash flow. Really, what we are truly selling is in a business is cash flow. And what are you willing to pay for it? And this brings up a good point. And hopefully this is a good, I don't have to bring this up again. But if your value, if you file your tax return and you get down to zero, and your tax return shows a zero balance after the end of the year. So your net is, don't show any profit because you're trying to avoid taxes. Who wants to pay for a business with a zero profit? And I pose that question to and ask. Accountants are great. They reduce your taxes significantly. But if you're selling cash flow, who really wants to pay for a net zero profit? Not that many people. And so, we have to, when we're thinking of succession, our mind has to shift, and we have to look at it from the eyes of the buyer and not the eyes of what I need to for today. And that's a critical step. Trade secrets. Do you have any kind of secret sauce or secret customer list or anything else like that? Those are all protected, but how protected do you have it locked down? So that's going to be critical. So 3 types of succession plans. And we have to look at, the first one is everyone needs a continuity plan. And whether at any point in time, because we know for sure 100% all of us will die at some point in time. That is a guarantee. So we know that there's going to be some kind of transfer at some point in time. And the question is, how is the operation going to continue? So continuity, we'll talk about that here in a second, but that is for everyone. The second part is family. You can sell it to family members or you can sell it to third parties. And there's positives and negatives to each one of those. But you have to pick one, or you need to be thinking of one of those. Continuity. Usually, continuity plans, you're looking at buy-sell agreements. Buy-sell agreements can be implemented. And if you're the sole owner of the business, don't fret. There is ways for us to look at buy-sell agreements, and I love this, and I do this a lot with professionals. But sometimes I'll get a couple competitors to get together to jointly work at continuity plans, so that you have somebody to come in and buy you out if necessary in case of death. So that's always an interesting conversation. But it may be that management comes in and buys you out. Key employee comes in and buys you out. So there's all kinds of different things with regards to that. But funding, it could be through cash, it could be through debt, it could be through a sinking fund. Basically, people are buying in through based upon a certain fund, or loans, installment plans, maybe private annuities, life insurance. Those are all part of funding that continuity plan. All right, so insiders. So if we're selling it to somebody inside the organization, there are there are some options, including ESOPs, employer stock ownership plans, pension plans, basically where employees buy stock in the company and fulfill certain obligations, and then the company, the pension now owns the stock, and the owner walks away. So those are always interesting or useful objects. There's grants, basically a trust, two different types of trusts, and also gifting. Those are also opportunities. Sale to insiders. ESOPs, they're very similar to 401ks. The ESOP invests in the stock of the company, can borrow money to do so. And there's a lot of advantages for ESOPs. You're getting the fair market value of it. You're reducing some of the finance costs, because if you have to sell to an insider, the problem is when you're selling to an insider, there's always a risk that they're going to default, they're not going to have enough cash, and things of that sort. Also provides job security for all those individuals, and avoids some capital gains taxes, and provides a little bit of control with the owner. The owner has control over who is on the committee, on the ESOP committee, and management and things of that sort. You can sell to family members. Statistically, if we look at family members, put the shares in the form of a trust. You can exclude some of the transfer from estate, from your estate and estate taxes. We can set up annuities. We can provide for charities, and we can also work through life insurance as well. It's a good option. It provides you a long-term strategy, and to a certain extent may avoid some taxation while passing value to the business, value of the business to family members. You can do some gifting with your employees or to your family members. But there's potential conflicts within family business transitions. The family unit. If you have a family member, say you have two kids. One works in the business, one doesn't work in the business. And you transfer the ownership to both individuals. The person that has been working in the business may not get what they truly wanted. They're now sharing with a person that's not working. So there's definitely some risk with regards to that. Ownership and control. Usually with family members, the owner doesn't really want to give up control of the business. So there's definitely some risk out there. Compensation, when you're a family member, I know even with my family, I have one of my sons come in and do shredding or do this or do that, and I always view it as, I really want them to just work. I don't want to have to worry about paying them. But on the flip side, family members need to pay their bills, need to be able to do fun things, and so there's always that dichotomy that you have to fight through. Then you also have non-family managers. So if somebody's running the business until your family gets older, that's important. So there may be a conflict because that family member or non-family manager should be compensated or for their sweat equity. So the issues affecting family business transition, if we look at a transition between generation 1 and generation 2, you may have a successful transition. 40% will transition to the next generation. But out of those that still have it, maybe 5% go to the third generation. So having it for 2 or 3 generations, there's usually problems getting the family members to transition. And you just need to be ready to know that, family business transitions may or may not happen. But if we have a good plan, we've talked through things, we have a clear goal, it can happen. A failure to address issues of who will run the business, that's a huge issue. Failure to ensure that the surviving spouse will have their ownership interest in sufficient lifetime income. If you own the shares and you're just receiving a salary and there's no transition and the main owner dies and the spouse is still there, they may not have that continued income, which you need a plan for. So third parties is basically, it is what it is. You're selling to a third party. It's not a traditional succession plan, but it's a plan. And selling to a third party is a 4-step process. Step 1 is a lot of cleanup. You're cleaning things up, making sure that you've got everything well established and documented. You've hired advisors. You've looked through the market and you've picked a time to sell. And all price and terms are negotiable. So that's always helpful. Benefits: sales result in cash to the owner. So unlike selling to a family member or selling it to an ESOP or selling it to anybody else, you're going to be walking away a lot of times with cash in hand, usually funded by a bank. There's less financial risk because you're selling it to one individual and you're walking away with a pile of money. You don't have to worry about family issues or family succession, and the exit can be completed fairly quickly. It doesn't, you're talking about beginning to end, you're probably looking at maybe a year, getting everything ready, getting all your due diligence ready, tax returns, and things of that sort. But there are issues. Failure to prepare, underestimating buyers. Usually buyers are pretty sophisticated, so they're going to have certain expectations. And then accepting the first and only offer. You may only get one offer, and if there's not anyone competing to give you that offer, that provides more risk. So, valuing a business. The value of business is what someone else is willing to pay for it. Bottom line. There's always, it's like a piece of real estate. Somebody says, oh, it's worth $1 million, but the foundation's falling in. And you offer them $10, your $10 offer may be a reasonable offer. The question is, do you have any cracks within your foundation? And that's what you need to patch and make sure that it's taken care of. Standalone operations are valuable. Looking at the operation in itself. Determining what fair market value is. There's definitely rules of thumb and appraisers that can come out and evaluate your business. So yeah. I know I got about five minutes. left, but I want to keep going and try to get through these slides because we're on the back end. But step 4 is succession planning, financing and arrangement. Once you've gone through steps 1, 2, 3, and you've gone through all the kinks, you're ready to move forward, it starts getting emotional. And a lot of times we'll start bringing in people to help with that last part. Because the question is, will this be you? Of course, I can always stay on in a purely advisory capacity. Everybody wants to, once you leave, a lot of times people, they may need 2 or 3 weeks, maybe 6 months to listen to the person, but they may not want a long transition. Typical time periods are anywhere between 2 weeks and 2 years. So that's critical. And critical in preparing yourself for this. You've got to be ready to release that control. And I know that's a hard issue. Writing a succession plan is time intensive, very tedious, and it takes a long time. So, but this is a typical succession plan where you identify the goals, define current income, look at, dependence of on the business income, identifying your needs and goals, creating that best case scenario, and design your goals so we can meet your best case scenario, and then manage that succession plan. Last important takeaways. That I want to drive home is when is the best time to sell? When you're ready. But you've got to start getting ready. That's probably the biggest thing is, this is a mammoth undertaking, and you've got to start getting ready for that and start setting up that plan. To get a business truly ready for sale will take 5 years. To get your income right, to get your finances cleaned up, to get you moving in the right direction, it generally takes about 5 years. Picking the right entity, so entity selection is always going to be a critical step, and making sure that that's identified and figured out. Then having logical buyers and consider the investment. Sometimes we'll get investment bankers and business brokers involved in the sale to market the business. But succession planning is about keeping your business running under changing circumstances and being ready for those circumstances. Because we never know when we will be disabled. We'll never know when we are going to die. We'll never know when key managers or key customers are going to leave, and things that sort. So there's definitely changing circumstances. You need to provide for protections against not just estate taxes, but all taxes, and then maximize your business. And then that's it. Does anybody have any questions? I don't see any earlier. All right. Well, I just truly appreciate you guys taking the time to listen to this webinar on succession planning. It's a difficult topic. There's a lot of intricacies to it, and I truly appreciate you spending the hour to listen to me talk about this. This is one of my favorite topics, and I just really appreciate you coming in. If there's anything I can do for you, please don't hesitate to let us know, and we look forward to seeing you soon. Thank you very much.